I'm out for a quick walk, so I thought I'd do a quick video on the tariff situation, which has been a huge driver in the markets, at least the investor reaction to what's taking place. Tariffs have been in the background, but there's still a driver, and I think things are changing a little bit. And I want to talk about that and how it affects the stock market. We saw tariffs go to 145% on China. Most investors said, well, that's ridiculous. That's an embargo. That's not going to stay. And I thought that it would actually take a lot longer to work out between China and the US. Now, it's still not worked out. We have a temporary pause right now. And the resolution so far has been better than expected, at least the speed of what's taken place. And that's been a good driver for the markets. The markets have also been driven by cost short covering and a little bit of FOMO as well. But nevertheless, has been better news than expected on the tariff front. So investors see that 30% for China as being the cap, where tariffs won't go above that. So they feel a little more secure to say, well, that's the cap. Now, some analysts expect the tariffs to remain on China at 30% for 2025. Most investors expect the tariffs to actually head lower than that, including me. But I think investors are a little bit too optimistic about where the end goal, the terminal point for the tariffs. If we take a look, the US has actually worked out a deal with the UK. Now, without going into the particulars of the deal, I gotta say that this was the easiest deal in the world to get done because the US has a surplus with the UK. So, I wouldn't model the expectations for other countries on that. So, investors, I think, really believe that we're probably going to see the tariffs come down to somewhere in the single digits. And I think that might be a bit optimistic. Now, so where do we stand right now for the effective tariff rate at where we are right now? According to the Yale Budget Lab, it's 15.4%. which is the highest it's been in 80 years. That's extremely destructive on the economy if we stayed at this level. And you can say, well, the US would do some onshoring, producing more product in its own country, but that wouldn't have an impact for a few years. So it's extremely destructive where we are. And it's still going to be destructive wherever we move to, unless you believe that the U.S. is going to take away all the tariffs that they have, and we're just going back. It's just a big game. We're just going back to where we were, or it's all really low single digits. We're going to end up worse off on an economic basis than where we are, or where we were before this whole thing took place. So, I think investors aren't building that in at this point. They're just excited to see the rate of change and improvement for the tariff situation. And the short covering is really pushing things higher. Yes, things are going well for companies. The tariffs haven't affected their margins because they front run the tariffs. Companies like Apple rented 5 planes and shipped over a whole bunch of iPhones ahead of the tariffs. And if we take a look at actually who's bearing the brunt of the cost of the tariffs, China is actually bearing the brunt of a lot of this. They've lowered their profit margin. Ultimately, it's going to be the consumer that pays. But in the transition zone where you've got tariffs coming in, China says, well, we'll pick up some of that slack. U.S. companies are also probably going to pick up some of that slack. And the consumers are also going to get hit. So it really depends on the proportion of the supply elasticity supply curve, the elasticity of the supply curve. Now, U.S. companies actually have room to absorb some of that. Now, why do I say that? Because the profit margins are very high historically. And typically they move down from this level. They're over 12%. And they've really been moving up, after 2000 because large tech companies were really dominating. And really after during COVID, inflation is a terrible, terrible thing. And what took place was companies said, well, inflation, our costs are going to go up. We don't know how much, but we have to pass our costs on. And so we're going to raise our prices. And that's exactly what took place. they just kept increasing their prices, and so the inertia of that just carried on even after the costs start to stabilize. It takes a while for competition to come back in and adjust that, and it really hasn't. So we've got these really high profit margins, so companies can absorb that somewhat in the short term. Now, that has a huge impact on earnings of companies, because profit margins probably aren't going to go higher from this point regardless, just because they're at historical highs. And if we see the US economy start to slow down in a significant way, like many other countries around the world, we'd expect to see those profit margins decline anyhow. So all that translates into lower profit margins, lower price to earnings ratios probably down the road. So we can't really get any better than where we are right now as far as that goes. I had to laugh because the CEO of Walmart came out last week and said, well, they've been absorbing, or they're working through their inventory on their product, so they haven't raised their prices, but now they have been working through that with new product coming in. They're going to have to start raising prices because of the tariffs. Trump came out with a tweet and said Walmart should eat the tariffs. Now, he does have a way with words. Now, Walmart's profit margin is 2.7%. So we're not talking like NVIDIA profit margins where there's lots of room here. And then we saw Trump actually call up the CEO of Walmart on the weekend. And the CEO said, yes, we will help bear part of that cost. Now, what do you expect him to say? Do you think Trump's going to come back in 6 months or a year and start to prorate the cost of product with the tariffs? No, that's not going to happen. So, of course, he's going to say that. And they probably will in the short term, but that will fade away. But I just had to laugh about that whole scenario. Overall, we've seen tariffs have a huge impact on the markets on the way down. We saw that big correction happen in early April. And then on the way up, as we had settled some of the differences, let's say. And the question is that going to continue to happen? So on the way down, bottomed in early April, but then we saw a lot of short covering that took place. The tariff situation did improve at a rapid rate, faster than people expected. And also a lot of FOMO took place as well. We didn't have like really positive economic news driving the market higher. Investors were saying, look, we think the market just deserves to get back to close to where we were before because things aren't as bad as what we expected. Can this continue? Well, let's go back to 2020 for a second and take a look at what took place there with COVID. Now, we saw that sharp bottom and that sharp rally. Now, we saw the continuation for that rally because the government was spending huge amounts of money, just dumping money, and the Federal Reserve was doing exactly the same thing, lowering rates, etc. We don't have that right now. So we have a tight monetary policy, relatively speaking, a government that's trying to cut spending but having trouble doing so. And economies around the world really struggling. Japan's in a recession. Germany's been in a recession for a while. The UK's struggling. Europe's struggling. So the backdrop isn't great economically either. And I think we've really seen this tariff situation resolving as a relief valve from an overreaction to the downside. Yes, the market can drift higher here, and maybe there will be some announcements coming out from different countries with the US on some of their agreements as well. I don't expect them to be big, huge movers for the market as we've seen so far. I think we're going to see more of the natural tendencies for the market to roll out here, and investors will start to take a look more at the economic numbers as well as earnings. Now, we're largely through the earnings season right now, and we are in that weaker 6-month period for the market. That hasn't had an impact yet because we've seen so much other stuff going on here. But I don't see the market. I think the expectations built in from investors for this tariff situation to be resolved are getting unrealistic. It's almost as if they expect it to go back to exactly where it was before. I don't think that's happening. And maybe you do, and maybe that's a different scenario. Even if it did go back to that level, there's still an argument to say the market's probably overpriced. But if we do see tariffs come in above where they were before the whole tariff debacle, that's going to have a restrictive impact on the economy as well. We're not going to see that impact really for a little while yet, because this all has a lag. Companies have been going through the inventory as we talked about, et cetera, et cetera. So we still haven't, it's very confusing to really get a grip on where we should be as far as that goes. But I think investors are being overly optimistic as far as the tariff resolution being worked out. So just a little bit of a caution here for the market on a go-forward basis. Thank you.